It was a bracing cup of java. Had to put a little holiday cheer in here because the subject we're talking about is so dreary. It's called National Income Accounting. And, excuse me, but I have to give you a little advice in your life. See, I never wanted to be an accountant. I never wanted to be an accountant because if I only had one day to live, I would have liked to spend it in Professor Thorpe's accounting class because it would have seemed like an eternity to me. And I never wanted to teach accounting, so I didn't. And now I end up teaching accounting, national income accounting. And I didn't do it for years. I just thought, I got tenure, I don't need to do this stuff. And then somebody came back from UCI and said, in my macro class, everybody knew what personal income was, and I didn't, because you didn't teach it to us. So now I have to do this. Do you understand? It's a tragic, tragic thing. I will explain more later. We've already done GDP using the value-added approach, GDP using the expenditures approach. The third approach is the incomes approach, because of the identity that the value of the goods produced must equal the income from the sale of resources to produce those goods. So now we use the incomes approach to sort of counterbalance or get a good idea of how accurate the other estimates are. Okay. So the resources are land, labor, capital, and entrepreneurship, and the payments to these resources are rent, wages, interest, and profit. So to produce things, you need the resources. To get the resources, you have to make the payments. The GDP statisticians measure the value of these payments. So first, they add up all of the rent payments, how they define rent, which things they count. As your business. I look it up. Wages to employees, to workers, interest payments, net interest, whatever that means, and profit. But in a basic accounting class, you learn that profits have to be broken out into proprietorships and partnerships profits and to corporate profits. They're different. And so under profits, we have proprietorship and partnership profits, and we have corporate profits. But then corporate profits get divided out three ways, and we'll see why in just a minute, why we have to pay attention to what happens to corporate profits. Corporate profits go to corporate profit taxes. Then some of the profits are distributed back to the owners of the corporations, those are the shareholders. And then some of it, the corporation keeps itself as undistributed corporate profits so that they can finance new investments and buy Lear jets to go to the Super Bowl for the top executives. Anyway, you add these all up and you get national income. And national income isn't exactly the same as GDP because there are a couple of things in GDP that are counted that are not counted in national income. And so the two things you have to add back into national income to get it to equal GDP is capital consumption allowance, which is basically depreciation here, and indirect business taxes. These are taxes like excise taxes on tires. When you pay $250 for a tire, maybe $220 of that is the payment for the tire, and there's an extra $30 that's taxed. So you have to account for that $30 somehow, and that's how they do it. When you add these two wrinkles, the capital consumption and indirect business taxes, you end up with GDP using the incomes approach. And then it's such a horrible job to try and do this statistical work. They compare this GDP using the incomes approach to the GDP expenditures approach, and then they just create a category called statistical discrepancy. And for the last several years, it's been approximately $100 billion or so. So that's it. The expenditures approach, GDP is 19.2 trillion in 2019 in real dollars, not nominal. So are you happy with this? No, you're not. I know you're not, because you're going to be just like that woman who comes back to me and says, you didn't teach this. So I have to finish it out with this. You want to know what net domestic product is. You're not happy with gross domestic product. You've heard net domestic. So what's the difference? To get net domestic product, you take gross domestic product and you subtract capital consumption allowance. That's the depreciation. Oh, merciful goodness. I love this thing. No. I love it. There you go. Federico hates that thing. Federico hates that thing. Too bad, Federico. We're trying to liven this video up a little bit. I don't think so. Anyway, so that's how you get net domestic product. Now, if you want to get back to national income, which we got on the previous page, national income, you take net domestic product and you subtract out indirect business taxes. So both of those two wrinkles are subtracted out, and we're back to national income again. But you're not happy with national income. You want personal income as well. I don't know why. Maybe you're just a person. So to get personal income, you take national income and you subtract these three things, and then you add one thing back in. And the three things you subtract is money that was earned, but it never got to a person. So corporate profits taxes stayed with the corporation. They never got to a person, so you take it out. Undistributed corporate profits, same again. It was part of income, but it never got to a person. And contribution to social insurance. When you get your check, they take money out for unemployment and social security payments and so forth. And it's a payment to you, but you never receive it. You're a person. So you take those out. And then there's one thing that people don't earn, but they get it as income, and those are transfer payments. A transfer payment is a payment for which there is no current service performed. So Social Security is a transfer payment. Unemployment, transfer payment. And so that's personal income. And finally, disposable income. And disposable income is the bottom line. If you have to try and do demand studies and figure out how much people are going to buy, well, income's an enormously important part of that. And so what income do you use? Do you use any of these incomes for your statistic to tell you how people will behave when it comes to purchasing in the next period, next quarter or something? It's probably disposable income, because disposable income is after-tax income available for spending. And so to get disposable income, you take personal income and you subtract personal taxes. And this gives you personal income. And that's about it. Oh, no, it's not. Sorry. Are there problems with GDP? Yes, there are enormous problems with GDP. Does GDP measure gross domestic happiness or gross domestic well-being? To some extent, yes, and to some extent, no. If you're interested in this at all, I would recommend to you that you go see gapminder.org. Well, there's a wonderful data animation that talks about income or wealth and life expectancy, income and health also. And there's some relationship between GDP and the health and life expectancy in a country. And then the other bit here is about personal freedom, that there is a relationship between GDP and personal freedom in the world. And it's a lovely accident of history that human beings who forever it seems have not had personal freedom or liberty, these days, in order to have a modern, prosperous country, the people have to be free. So you can look at a freedom index. That's interesting. But more concrete problems with GDP measurement. It's hard to measure, and they revise things continuously for 5 years, and oftentimes these revisions are significant. Also, counting the value of services is very difficult, and services is a big and growing part of the economy, and it's kind of badly calculated historically. So services and revisions are a measurement problem with GDP, and then there are conceptual problems. Turns out that household production doesn't count. If I stay home and take care of my kids, that doesn't count in GDP. But if I take my kids to the child care center and have them watched and and pay $1,000 a month, then that does count in GDP. In both cases, the children are being cared for, but one is counted toward GDP and one is not. There's an old question: what happens to GDP if Miss Daisy marries her driver? There's a movie called Driving Miss Daisy, and the answer, of course, is if Miss Daisy marries her driver, GDP goes down. Now, I don't know if well-being goes down, but GDP does, because previously she would have paid the driver, and now she doesn't pay him because they're married. And underground economy. How many exchanges take place, transactions take place that are not visible to the government, either because they're illegal or because they're legal, but people don't want to show them because of tax reasons. Anyway, they've estimated how much of the economy is underground and invisible to the GDP statisticians. And their guesses range from 5 to 20% of GDP. And even 5% of 19.2 trillion is a whole lot of wealth that isn't being counted because of the underground economy. Leisure is not counted. If I have more leisure time, I'm better off. But that increase in leisure time is not included in any category of GDP. And finally, economic bads. Bad pollution, for instance, is counted twice. The activity when the pollution takes place, whatever that production process was, that's counted, and then when people go to fix the damage from the pollution, that's counted again. So pollution is economic bads are counted twice. Anyway, that's GDP in all three dimensions of it. But I got to warn you about something. Wait a minute. Oh, I have to warn you about something. There's a test. Here's the test. See, here's your life. You go on for a while, and then you come to a fork in the road, and you either have to zig or zag. And you zig. So now you go on this path for a while, and then you come to another fork in the road, and you have to zig or you zag. Let's say you zag this time. So you go this way, and then you come to another fork in the road, and you zig this time, and you go this. Okay, that's how life is. You zig and zag through life. But if one day you wake up in the morning and you find out that you are a national income accountant, that is proof positive that you have made every wrong turn in your life. That every time you should have zigged, you zagged. And every time you zagged, you should have zigged. That's the test. National income accounting. What do you think? You like the story? I thought you did. Oh, Federico's not happy. I'll bet he's going to be really unhappy with this one. That's it, I give up.